Let's welcome straight in Pankaj Tibrewal, who's with us. He's founder and CIO at IKIGAI Asset Managers. Pankaj, thanks very much for coming on. Very red-looking screen. You're, of course, one of the early ones to turn cautious in your earlier avatar at Kotak, I remember. And now, of course, you're managing funds on your own. At what pace are you deploying, Pankaj? Because you turned constructive. You have been turning constructive over the last few weeks. So the pace of deployment and give us a sense. Yeah.
So Prashant, absolutely you are right. If you look at the screen today for the last month or so, one would believe that there's a black swan event which has happened around the globe or in the country. But on the contrary, we believe that things have started to improve at the ground. And let's look at the market into three parts, because markets are always a Triveni Sangam of fundamentals, flows, and sentiment. And let's address each one of them in separately. And please, accommodate some time for me to explain that better. So if you look at from a fundamental perspective from where we were, and our entire cautiousness for the last 12 months was that the market was divorced from the actual reality on the ground. Now, for the last 3 months, actually incrementally things are turning to be positive. The first point is the central bank. The central bank for the last 18-24 months was on a cautious side to make sure that there isn't overheating. And now the central bank is acknowledging that there is a slowdown, and probably the actions which are following have been very good. They did the rate cut for the first time in the last 5 years. You saw the liquidity measures being taken by RBI on a continuous basis. And third, the risk weightage and the relaxations on the risk side, which they have been doing. So clearly RBI, which was on a monetary tightening side, or a little hawkish, I would say, is turning to be more accommodative and neutral. And that's a very good news from a medium to long term. And they are turning pro-growth. The second one, which led to the slowdown in the economy and markets are taking cognizance for the last 45 days, was the slowdown led by government spending. And happy to state that December saw 170,000 crore of spending by the central government. And as far as our data sets suggest, the high frequency indicators in January and early part of February are also turning out to be incrementally positive. And the government is continuously spending on the capex side. And also when you speak to cement companies, long product steel companies, wires and cable companies, battery companies, all are saying that post October, November, starting December, things have turned out to be positive. And that's a very important sign. The third part is the rural economy, which was under strain for a long period, is turning out to be positive. We had 2 back-to-back monsoons, and clearly that started to show in the commentary of all the companies which have rural presence, that rural is doing better than urban. Now look at the tax rate cuts which have happened. And clearly the tax rate cut, if we went into the budget exactly a month back, saying that there could be lot negatives in the budget. But if you remember that day of the budget, it was far better than what the expectation was. And clearly the tax cut will start playing its role starting April of 25. So I think when you combine the government actions along with the central bank actions, incrementally it's positive than where we were 12 months back. Now look at the valuation side on the fundamental. Now our excesses, a lot was created over the last 24-36 months. A large part of that has been taken off. It's like playing a T20 match. 2018-19, we saw that it was a long grind. Now probably cycles have turned out to be shorter and sharper. And last 45 days has taken a lot. We were looking at the 4,600 stock universe, and about 85% of the universe is down by more than 25-30%. And median return of the index is worse than the index return itself. So I think the damage at the stock level has been significant. And on the valuation front, if you take a 12 to 15 months out, I think on a Nifty basis, valuations are below 18 times. assuming just 10-12% earnings growth for the next 2 years. So valuations have aligned itself to long-term averages. So when you look at the fundamental side, I believe that a lot probably is turning out to be incrementally positive rather than negative. Let's look at the sentiment side, Nigel and Prashant. Uh, and on the sentiment over the last 15, 20 days, we attended various conferences. We met a lot of investors, global, local. The mood out there is extremely negative. Nobody wants to, buy anything. People are just saying, what to sell, what to, do. So sentiment-wise, if that's any contra-indicator, I have never seen in my career such a U-turn in 45, 60 days without any basis on where there's a black swan event. So clearly, I think the valuation reset is happening now. The excess multiples which you all were giving to companies, probably that's getting reset. And earnings growth, in my view, will be much better than what the street is expecting for the next 2-3 quarters. Don't forget that the June and September quarter had a very low base, and optically, the earnings growth will look like double digit as you move into FY26. And even FY last quarter, if our data set suggests right, I think things are moving in the right direction from a growth perspective. And third quarter, data is out now. The earnings growth was 8.5% for NSE 500 companies on a reported basis. So overall, I think sentiment is extremely poor right now. But when that will again take a U-turn, nobody can call it. But my sense is most probably in the next couple of months, market should settle down. But let me give you a caveat that it will not be the same broader market way. Pick any stock, you will make money. I think that era is behind us. And incrementally, I think it will be a bottom-up stock pickers market. And people who can pick right companies, right management, right balance sheet, right cash flow, I think will be the winners over the next 18 to 24 months.
Okay. All right. Hi, Pankaj. Good afternoon. And good to hear those rational thoughts. Pankaj, the economy, the green shoots are there. Earnings will improve. As you said, sentiment is absolutely smashed. And to back up your point on the cement side, I understand that come in the next 2 days in South India, particularly in Andhra Pradesh, there's likely to be a 20 rupee price hike, which if demand is not strong enough, will not be digested. So all those factors taken into account. But why are we seeing this sort of selling pressure, right? I mean, we're nearly at around 22,000 odd. What is it? Is it the tax harvesting factor that's playing out here? The valuation reset, yes, that's at play as well, which I think more or less that's got aligned. If you could tell us, how are you reading the situation? If it's going to be tax harvesting, in the next few trading sessions, that will be done and dusted, which will be good news. The FI selling obviously is a problem, but that's not in our hands.
In one single line, Nigel, if you look at the history, in the last 45 years, every calendar year, if you take sensex as a benchmark, there have been only 4 years where markets have seen intermediate correction of less than 10%. So corrections are a part and parcel of any market. However, in the last 3 years, market participants have not seen such a correction and buy on dips made money. So when such corrections happened and a large part of incremental investors have joined the market in the last 3-4 years, it actually played on a sentiment side very badly. And in the first phase, you throw in the towel for every company. Good, bad, there's no discrimination. And I think that is what is playing out, that the structure of the market in the last 4 years have never seen a sharp correction like this. And sentimentally, people are completely taken aback that how it can happen, and they are throwing in their towel. But if you just take an objective view and just take a 18-24 months and a slightly longer call, I think on the hindsight, it will look like a great opportunity. When you are in the correction, it's the most difficult phase. But on the hindsight, every correction for the last 44 years looked as an opportunity. Our sense is that despite of intermediate correction, if you look at the data, 36 out of 45 years, markets ended in positive after that. So yes, this phase was necessary, that investing is simple but not easy. I think everybody has to pay a tuition fee in the markets. New investors probably are learning that way. people who can sustain themselves through a disciplined asset allocation probably will see wealth creation over the next 5-10 years. So I am not on the camp that sell everything and go away. I think what stood for India for the last 5 months back is still true for India. Nothing has changed. I think it's just the excesses which have been taken out. And incrementally, when you move from here, not everything will move. Just keep that in mind.
Right.
I think stock selection will become a very, very important piece for the next 12 to 18, 24 months.
Right. You know, that's a very fair description of things as they are right now, Pankaj. And you spoke about that Triveni Sangam as well. Just to add one more parameter to that, if you could speak on the flows itself, because a large part of the decline has happened because of the ferocity with which the FIs have been selling in our market. So if you could tell, if there is any data point that we should be monitoring very closely, which may indicate that at some point sentiment from the FII standpoint would bottom out. That's point number one. And secondly, you said that the next 18 to 24 months, when there is recovery, it will not be perhaps every all and sundry stocks which are moving higher. What would be the sectors which have the best bet of growth from here on, if one was looking at the market right now and for opportunities?
So, Mangalam, I think there are 2-3 data points which I would like to share with all of you. The first one is, at some point of time in the next few months, I think FI selling should bottom out. During this conference, I had the opportunity to meet some of the largest FIs on the planet who had come to attend the conference. And their only point was that we come to invest in India for growth. And if growth is not there, probably if we try to look out for other markets. I think if earnings growth starts to come back, which could be in double digits, I think FIs will come back. The second point is look at the data from CY21 till a week back. Domestic investors have poured in $140 billion and FIs have put about $2.5–3 billion. So in the last 4.5 years, FIs have not participated and they are waiting on the sidelines. Nifty from the highs are down by about 16–17% in rupee terms. But don't forget there's a rupee depreciation also. So in dollar terms, we are down by 20–23%. And China and other parts of the world, developed markets, have outperformed India in a massive way. Now, with what is happening in US, and we believe that US markets are at a very, very dangerous zone, and all the parameters we look at are pointing towards a bubble territory out there. If US market starts to unwind itself, we will have some pain in the interim, but over the medium to long term, I think it will be beneficial from a flow perspective. Because whenever you speak to any asset allocator, Mangalam, the answer we used to get that US is 70% of the world index. Let us focus there. India is 4–4.5%. Yes, it will gain priority provided you grow at a much higher pace. But our focus right now at US. If US sees a shakeout, our sense is that FIs will turn back to India from an overall structural perspective. So the point which I am trying to say, it's a cyclical slowdown which we have seen in the economy. That's starting to come back. It's not a structural slowdown, in my view, in my humble opinion. And probably after 12 months, we will think that this 2–3 months, which we saw deep cuts, great opportunities. Mangalam, coming to your sectoral points, we did an exercise 2 days back within the team. And it's a very interesting exercise, which the results were. So we looked at the NSE 500 companies, and we said that how many companies have delivered 10%, we just took as a benchmark, earnings growth of more than 10% for the last 5 years, for the last 3 years, and for the first 9 months of this fiscal. There were about 130 companies which have delivered more than 10% earnings growth out of the NSE 500 over a 5, 3, and a 9-month period. Then we looked at companies which have delivered over a 5-year and a 3-year, but missed on the first 9 months of this fiscal year. And there were about 105 companies more. So 130 plus 105, about almost 235 to 40 companies out of a set of 500 companies. And then we looked at where there has been the maximum derating on the P compared to the 5–6 year average of that stock And there are some interesting names popping up. And we believe that in this correction, if one is open-minded and have a slightly longer-term view, this correction is providing some great franchises at decent valuation if we extend your horizon out there. So I think from that perspective, we are not biased by any caps. I think a lot of mid and small cap companies with great franchises, domestic-facing economy sectors are looking very, very good. And there's a pivot in our view, which will happen from industrial cap goods to consumption over the next couple of years, and we need to capture that pivot as well.
Could you narrow the parameters by which you are saying there are interesting companies?
Why don't you? I think the same sectors, Pankaj, chemicals, and why don't you name 4-5? It'll be useful for viewers with full disclosure, not.
So it's not a recommendation to buy and sell, but market is telling us there's a underlying shift which has started to happen from a portfolio sectoral allocation. Look at the private sector bank and NBFC, and $13 billion of FI selling has been done in the first 45 days. Despite of that, many stocks in the private sector bank and NBFCs are in green in this mayhem. So that shows that the underlying shift has started to happen from few other sectors to banking and NBFCs, which had not performed for the last 5 years. The second is chemicals, selective out there. But I think the momentum which we are seeing in the business has started to be quite reasonably good. And don't forget that Trump has announced tariffs yesterday for Mexico, Canada, incremental 10% for China. If it doesn't do anything for India, maybe or optically he does a small number, trust me, over the next 12 to 18 months, a lot of sectors will see huge amount of opportunity emerging because China will be 20-25% more expensive in terms of tariff. So I think at that point of time, people will try to see which are the sectors, but I think chemicals can start out. Biotech, pharma can be another winner over a period of time. The third sector is metals. Normally, metals have a very high beta. But if you look at this time around in this correction, metals have surprised us because they have not corrected as much. That means market is telling us that somewhere there's a floor on metal prices. And incrementally, if you look at copper has started to move up, aluminum has started to move up. There's a slight bit of uptick on the domestic steel prices. And if there's an anti-dumping which comes through, I think probably ferrous, non-ferrous both can do well over a period of time. That's the third sector. The fourth is clearly, which we spoke about, cement. Incrementally, especially the North cement players, whoever we have interacted with, have been talking very positive in terms of both demand and pricing. And incrementally, our view is that the profitability will be much, much better than what we have seen in the first 3 quarters. And last but not, I think consumption could be a second half FY26. And that's a very large section of the market, especially the consumer discretionary names. And there are some interesting opportunities emerging where we believe that the runway to grow is next 5, 10, 15 years. And these companies are now started to be available at reasonable valuations. So these are the 5-6 sectors which have started to look good from a bottom-up perspective. And I think now we have to dig deeper into companies and see where there's a reasonable amount of margin of safety.
Okay, all right. Thanks a lot, Pankaj, for joining in and giving us those reassuring words. For the time being, I think the big takeaway is economy is doing fairly well. There are a couple of tailwinds as well. And maybe bulk of the negative news is already in the price, at least most of it, going by what you're saying. A lot of lead indicators on ground are looking up. And the RBI action as well will hold us in good stead for the remaining part of this calendar year.